Most people think the biggest risk in retirement is actually spending down your portfolio and running out of money. In reality, one of the biggest risks retirees face has nothing to do with spending. It has to do with when markets decline. And this really catches people off guard all the time. A lot of retirement planning is built around long-term averages. And long-term averages feel comforting, right? They give you this idea of if you are patient and disciplined, that everything will work out. But retirement changes the math. And when you retire and you're experiencing periods of volatility, it's no longer something that you hear about, it's something that you're experiencing, right? It's real. And at this point in time, the order of returns matter much more than the average return in and of itself. Let me give you a simple illustrative example for how we see this play out in practice. Now, this isn't a real client, but this is a scenario that we run into often. Imagine two retirees who both leave work at the same time. They have similar sized portfolios. They have similar market-based returns. They're both intentional savers. They're both spending reasonably within their limits. There's nothing crazy going on within their portfolio. The one thing that is different is the sequence or the order of returns. The first retiree experiences negative returns at the beginning of their retirement when they're starting to take income. The second retiree experiences those same losses. They just do so later after the portfolio has had time to grow. See, on paper, the averages tend to look quite similar, but what those two retirees face, both emotionally and practically, is drastically different. Right now, we're talking about the same market, we're talking about the same long-term averages, but we're talking about drastically different outcomes. The retiree that experiences negative returns in the first couple years oftentimes feels under constant pressure, right? There's this low-grade anxiety that tends to chip away when they're taking distributions from a portfolio. Every market downturn feels personal. And that individual didn't do anything wrong, right? This is just a symptom of taking money out of unpredictable market. It leads to a much higher level of uncertainty. Now, this is exactly why structure matters so much in retirement, right? If we go back to that 3-bucket framework, liquidity gives you breathing room and it gives you cash on hand, so you don't have to raid accounts at inopportune times. You have reliable income accounts that help you generate the income that you need that is not dependent on the stock market. And then you have long-term growth accounts that are really meant to grow and preserve your portfolio wealth over time. Now, this structure doesn't eliminate risk completely, but what it does do is help you effectively manage and reduce risk when you're exposed to it. Here's the good news. These risks are actually manageable. You don't need to put yourself in a position where you're trying to predict returns. You don't need to put yourself in a position where you're trying to time things perfectly. You just need a plan that's actually built around uncertainty, not smooth, predictable returns. Now, understanding this is one of the most important mindset shifts someone can make as they transition into retirement. When people understand this, retirement starts feeling a lot more intentional and a lot less reactive. And when you transition into retirement, this is one of the most important mindset shifts you can make.